This is problem 6.6, recording general journal transactions. The transaction on January 1st, we received cash for providing the service. So we debit cash in bank for $125. Debit increases the asset cash in bank. We credit the revenue account, boarding revenue as a normal credit balance, increased with a credit, so we didn't have that revenue before. So we debit cash in bank, $125. Credit boarding revenue, $125. Source document receipt, $300. On the 3rd, the owner invested computer equipment in the business. The business did not have the computer equipment before, so we debit cash in bank. We debit computer equipment for $2,500 and credit the owner's capital account, $2,500. The asset has increased with a debit. The owner's capital has increased with a credit. Our source document is memorandum 33. On the 5th, we provided a service to Juan Alvarez on account. He's our customer. We provided grooming revenue for him, but he did not pay us, so it's on account. When someone owes us money, it's a debit to accounts receivable. The asset account, accounts receivable, increases with a debit, decreases with a credit. Grooming revenue has a normal credit balance. It increases with a credit, decreases with a debit. So we provided that grooming revenue on account, debiting accounts receivable Juan Alvarez $80, crediting grooming revenue for the $80, our sales invoice $212. On the 9th, we paid our utilities expense with a check. So we're debiting the expense account, utilities expense for $150, crediting cash in bank, the asset. Cash in bank decreases with a credit, $150. Debit utilities expense, $150. Credit cash in bank, $150. We wrote a check. Source document, check, $411. The owner withdrew funds from the business. Transaction on the 11th. As soon as we see a check as a source document, we know we credit cash in bank. Why did we write that check? It was for the owner. So we have the contra account of withdraws to the owner's capital account. Abe Schultz withdraws a normal debit balance, increases with a debit, decreases with a credit. Cash in bank, an asset, decreases with a credit, increases with a debit. So we debit Abe Schultz withdraws for $700, credit cash in bank for $700. Source document, check, $412. On the 14th, we purchased kennel equipment on account. We didn't pay for it. We didn't have the equipment before, so we debit kennel equipment for $2,600. It's increasing the asset, the equipment account. I did not pay cash, so I'm crediting accounts payable, Dogs and Cats Inc. I now owe Dogs and Cats Inc. $2,600, so it increases the liability by $2,600. Accounts payable, Dogs and Cats Inc. The invoice DC92 is Dogs and Cats Inc. So we debit kennel equipment $2,600, credit accounts payable, Dogs and Cats Inc. $2,600, source document, invoice DC92. On the 16th, we paid our salaries expense. Again, we wrote a check, so we know we credit cash in bank, decreasing the asset cash in bank for $400. I need a debit. Why did I write that check? It's an expense. Expenses have a normal debit balance, increase with a debit, decrease with a credit. So I'm increasing salaries expense with a debit, $400, crediting cash in bank for $400. The source document is check 413. On the 18th, the owner withdrew an asset, but this time it's office equipment. So he's taking that asset, he's withdrawing the asset from the business. We still show that as the owner withdraws. So we're debiting Abe Schultz withdraws. It's an owner's equity account that increases with a debit. We no longer have the office equipment, so we have to take that off the books. We decrease the office equipment by $65. And our source document is memorandum 34. On the 23rd, we received cash. Why do we receive that cash? Because Juan Alvarez paid us back. So it's received cash on account. I received cash. The key is there. I'm debiting cash in bank, an increase of the asset of $80. Juan Alvarez no longer owes us that $80, so the way to decrease the asset is with a credit. In this case, accounts receivable Juan Alvarez is credited for $80, and it's our receipt 301. Debit cash and bank $80, credit accounts receivable Juan Alvarez $80, and receipt 301 is the source document. On the 28th, we purchased grooming equipment on account. We bought the equipment from Pet Gourmet. We didn't pay cash, so we owe Pet Gourmet $250. I didn't have the asset at first. I now have the asset, grooming equipment, so I increase grooming equipment with a debit, $250. I increase the liability, accounts payable, Pet Gourmet by $250 with a credit, and it's Pet Gourmet's invoice PG 333. Transaction on the 31st. We're writing a check. Why are we writing that check? Because we are making payment on account. We decrease accounts payable with a debit. I increase accounts payable with a credit. So we're making payment on account. We're paying back someone that we owe. So as soon as we write a check, we know it's crediting cash and bank, decreasing the asset, cash and bank, $1,300. Why did I write that check? Because I'm decreasing the liability. Accounts payable, dogs and cats, is debited, $1,300. Credit cash and bank, $1,300. And my source document is check 414. And the total of the accounts receivable accounts on January 31st is 0.